This video focuses on the closing process. You recognize the accounting cycle, this slide that I've shown you several times. In this video, we are going to focus on step number 8 that you see here, and step number 9, the trial balance that you're going to prepare after the closing process. So again, I'm going to show you a similar slide, the accounting cycle, which is represented here by the two boxes. In the small box, you find the different things that you need to do during the accounting period. During the accounting period, as always, you only have to do 3 things: analyze transactions, record the journal entry, and post the amounts in the general ledger. At the end of the accounting period, there are several things that you need to do. Prepare the first trial balance. Then you'll have to adjust. Adjustment is chapter number 4. Prepare a complete set of financial statements, income statement, statement of stockholders' equity, balance sheet, and the cash flow statement. In this video, we're focusing on the very last thing that you need to do just before a new accounting period starts, where you need to close revenues, gains, expenses, and losses accounts. When I tell you that we're going to close those accounts, it means, in other words, that we're going to empty those accounts. And where are we going to empty those accounts? That is something that I've told you several times in class. We're going to bring them in our retained earnings accounts. So that is what we're going to do in that video. So we're going to see that, in fact, we are transferring net income into this retained earnings account. In fact, there are 2 different types of accounts. Some accounts are called the permanent accounts. Some accounts are called the temporary accounts. The permanent accounts, which you have here on that slide, that represents the assets, liabilities, and stockholders' equity accounts. Those accounts, the balance sheet accounts, are not closed. They are not emptied at the end of each accounting period. So their ending balances before a new accounting period starts will not be brought to 0. It's only the temporary account here on the left-hand side that will be emptied. So that means that at the very end of the accounting period, you bring the balances of the temporary accounts to 0. You empty those temporary accounts into retained earnings so that in a new accounting cycle, these accounts start with a 0 balance, a 0 beginning balance. And what are the temporary accounts? They are here. You have revenue accounts, expenses accounts. These are income statement accounts. And you have here a new account, income summary account, which you're never going to see in the financial statements because this new account, income summary, is only used for the closing process. So as I've just said, the revenue, expenses, gains, and loss accounts are temporary accounts. And the balance sheet accounts, asset liabilities, and stockholders' equity accounts, they are permanent accounts, and they retain their balances from one period to the next period. So let me show you how the closing process functions. There are 3 steps. Step number 1, you have to close the revenue accounts. Step number 2, you have to close the expenses accounts. And step number 3, I'll explain a little bit more about this. Step number 3, you'll have to close this new account I've introduced a few seconds ago, the income summary account. Let's see how this closing process functions. I start with here a trial balance from a company. Fast forward. You have here different types of accounts. What you need to do, step number 1, do you remember? Close all the revenue accounts. On the following slide, I've highlighted the revenue accounts, 2 of them. So those 2 accounts have a credit normal balance. They're on the credit side, right? So if I want to empty, if I want to bring those 2 T account, consulting revenue and rental revenue accounts, to a 0 balance, I have to debit the same amount of these 2 T accounts. Let me show you. Here you have the credit balance taken from the trial balance from the earlier slide. If I want to empty those accounts, means that I want to bring those accounts to an ending balance of 0, I have to debit 7,850 in the consulting revenue account. I have to debit rental revenue, the T account rental revenue, by an amount of 300. And if I debit 8,150 in those two revenue accounts, I have to find a new account in which I have to credit the sum of these two amounts, which is this new account that I've introduced earlier, the income summary account. So I debit my two revenue accounts that I want to empty, that I want to close, and I'm going to bring the sum into this income summary account. Let me show you the journal entry. I debited consulting revenue 7,850, debited rental revenue 300, took the sum of the two amounts, and I credited the sum of 8,150 in this new account that I just opened for the closing process. That's step number one. Step number two, do you remember, is to close the expenses accounts. If I go back to the trial balance of Fast Forward, you recognize here on the trial balance 6 expenses accounts: depreciation expense, salary expense, insurance expense, rent expense, supplies expense, and utilities expense. I'm going to do the same in step number 2. To close my expenses accounts, I have to credit the amounts of all these 6 T accounts in order to have an ending balance equal to 0 in those 6 expenses accounts. So here recognize the beginning balance before the closing process takes place, taken from the trial balance. In my 6 accounts, I have here the ending balances found in the trial balance. These are given. Now, what I'm going to do in this step number 2 of the closing process, I'm going to credit the same amount in these T accounts. Here they are. I credit 375 in my depreciation expense account, credit 1,610 in my salaries expense, credit 100 in my insurance expense, etc. I credit as well the 3 other amounts. So what I'm going to do, I'm going to have to find a new account that I need to debit in order to have my journal entry which stays in balance. For my accounting equation to stay in balance. So now that I have put together my 6 amounts, the sum of my 6 amounts that I have credited is 4,365, which I debit in my new account income summary, which you have here, the income summary account, which you have here. Let me show you the journal entry. The income summary has been debited on the previous slide, and my 6 expenses accounts have been credited, have been emptied. Now they're closed and they are ready for a new accounting cycle to start, right? So now if I go back here to my previous slide, if I focus now on my income summary account, look, focus. What do I have on the credit side? I have my revenues. What do I have on the debit side? I have my expenses. So what do I have here? It's written here. It's my net income. It's revenue minus expenses. So a lot of students ask me, what type of account is the income summary account? Is it a minus plus account, or is it a plus minus account? Well, the answer is it depends. It depends if the revenues are greater than the expenses, which is the case here, then you have a net income that you have on the credit side of the T account. So in order to empty my income summary account, which will be step number 3 of my closing process, so if I want to remove my net income from my income summary, I will have to debit that amount of 3,875 for my income summary to bring the balance of my income summary account to 0. But let's imagine the situation is completely different. The revenues, if they are smaller than the expenses, then what's going to happen? we're going to have a net loss. So this amount, this is not the case here, but this amount on the debit side would be greater than on the credit side. So that means that we would have a net loss here on the debit side. And in this case, the income summary account would be a plus minus account. So to remove the net loss, I would have to credit my income summary account. And remember, step number 3 is to empty this income summary, bring it into retained earnings. So you see, what you have to understand now, if you focus, we're bringing all our revenue accounts into retained earnings. We're bringing all our expenses accounts into retained earnings, going through this intermediary step, which is to bring them first all into our income summary account. And I'm done with step number 2. Let's focus on step number 3. That is step number 3. I'm going to empty my income summary and bring it to retained earnings. So again, I'm going to debit my net income from income summary, bring it on the credit side of retained earnings. Let me show you the general ledger. Again, I had my net income here on the credit side. I want to bring it into my retained earnings account. That means that I've shown you the journal entry first. You have to debit that amount from income summary and bring it here in retained earnings. And in fact, I have updated my retained earnings account. Now, the company is ready to start a new accounting cycle. Now the company has all its revenue accounts which are empty, all its expenses accounts which are empty, and that's the idea of the closing process, is to empty those accounts so that those accounts are ready to record everything that will happen in the next accounting period. So there is no noise between the revenue of the previous year and the revenue of the year that is just starting. So you know exactly how much revenue you're earning into this accounting period because you've removed all the revenue from all the other years. So the revenues of this year will not be mixed, will not be together with the revenues of the previous years. So that's the idea of why we close those revenue and those expenses accounts, why we close those temporary accounts, we bring them into retained earnings. So that's the closing process. Let me just show you what you have in your books. You have a 4th step, which is to remove from retained earnings the dividends which have been declared. But this is something I have explained at the beginning of chapter number 2. We deal with them separately, but in case you haven't dealt with them before, you know it already. When you declare your revenue, you're going to debit your retained earnings account and you bring it into a dividends payable account. So this is a liability here. Huh? So it is a minus plus account. So the dividends payable will be credited when the company declares a dividend. On this slide, you have a summary of the closing process. Step number 1, you close the revenue accounts. You bring them into income summary. Step number 2, you close the expenses accounts. Again, you bring them into the account income summary. Step number 3, you're going to transfer the net income into retained earnings. You will have to debit your income summary account if there is a net loss. You will have to credit your income summary account if there is a net loss. And in this case, you will have to bring the net loss on the debit side of retained earnings. So you will use your reserves to make sure that you're compensating for your net loss. Then you have this step number 4, which is explained in the book in the closing process, but that I have explained separately. Now that we're done with the closing process, I'm done with step number 8. Let me just take a few more minutes to explain the trial balance that you have to prepare after the closing process. This is the very last thing that you need to do before, in a few seconds, a new accounting period starts. So what about the trial balance which is prepared after the closing process, the post-closing trial balance? You don't have any more temporary accounts. So all the temporary accounts have been closed. So the post-closing trial balance will only have the permanent accounts. So you will only have the balance sheet accounts, which have not been emptied. You will have the assets, the liabilities, the stockholders' equity accounts, and you will have as well the retained earnings account, which is now up to date, which you have now corrected as you have included into the retained earnings account the net income or the net loss. So a post-closing trial balance will appear to be much shorter than the trial balance that we have looked at before. Why? Because here you don't have at the bottom of retained earnings any temporary accounts. All of them have been closed. So the revenue accounts and the expenses accounts have disappeared from the trial balance. And here we have, in fact, updated the account from retained earnings. And that's the whole idea of the closing process, is to update this retained earnings account so that the retained earnings account now includes the net profit of this accounting period that finishes right now. That is the closing process and the post-closing trial balance.